So next we're going to have Darryl. And Darryl is the Palmyra branch manager of the Atlantic Union Bank. He's a graduate of Wright State University with a BA in history. He's married with 3 children from a previous marriage, and he and his current wife, Laura, moved to Lake Monticello from Dayton, Ohio in December of 2016. He worked in the banking industry for 16 years in Dayton before accepting the position with Atlantic Union Bank. It was Union Bank then, Union Bank and Trust. Atlantic Union Bank is the largest Virginia regional bank, with all decisions being made locally out of Richmond. They're large enough to offer multiple services in both personal and business banking, and small enough to be a part of the community. And Darryl is a part of our community. He does a lot of volunteering, and the biggest one is he's the treasurer of our board here at the Chamber of Commerce. So without further ado, Darryl.
Thanks, Ruth Ann, and thank you, Rebecca. That walks into this quite well. Okay, so I'll start off by simply saying it's going to be an overview of MoneyBasics. As Rebecca had mentioned, we're going to talk about the relationship with the bank, with your financial institution, how that leads into loans, lines, and expanding that relationship over time. So for right now, I'm going to talk a little bit. Rudy, if you can go to the next slide. I'll have some bullet points on here, and I'll just touch base on each one. Okay, so about checking accounts. Now, when most people, when I ask them where they currently bank, they're generally going to say where their checking account is. They might have loans other places, mortgages other places, but their actual bank is considered that in which they have the checking account. Now, in many cases in our industry, someone might bank personally at one bank and bank with business at another. And so, and a lot of times they might think, because we're going to start off by saying, keeping the businesses and personal finances separate. That doesn't mean it necessarily has to be at 2 different banks, which at times can cause a bit of a hassle going back and forth and getting money, transferred from one to the other if need be. But keeping business and personal finances separate is important, though. Okay, and that can be done at one institution. Many people do online banking now, both personal and business, and those are separate through our lines of, offers that we have, because they're under different tax ID numbers. One, of course, your personal, the other, your business tax ID. And to keep those separate is a number of good reasons. And I'm sure Rudy can attest to this. Tax purposes, it makes things a lot cleaner, a lot easier if you're not, mixing funds at that point. The next is just transparency. If you add a partner or something later into the business as it grows, your previous financials are totally separate from your business, so you can tell clearly what was done for the business side of it. And also, as I had mentioned, the online banking aspect, keeping those two separate. So now, speaking of that, the checking accounts being at one institution and that being your bank, so to speak, where your checking account is at, that goes to how the bank views you as a checking account customer. A checking account customer, or checking account is what is basically called a core product. People do get stuck at banks, well, a lack of a better term, I guess. And sometimes they really like the relationship, others they don't. It's tough to move because you have a lot going on in your checking account. It's direct deposits, automatic withdrawals, and you can add all that stuff through your business banking account also. And so it becomes that core product, and it builds a great relationship. We kind of see how you handle your finances. We have a history to go off of. It's a very important part of the banking relationship, which would then, and if I'm going too fast, just please somebody throw up a hand and say, slow down a little bit. But
Hey, Darryl,
yes.
if you could speak up just a little bit, a couple of folks are having a little bit of a hard time hearing you.
Oh, sorry. I feel like I'm yelling, but maybe I'm not. I might be blocking the microphone a little bit. Is that better?
I think so.
Okay. I'll get a little closer to it too. Sorry about that. You guys got to see me a little closer up. Now we have multiple types of business checking accounts. And most banks will have some of these. Now I know that we have a free business checking account that allows up to 100 transactions with no charge. Not everyone offers that, but it's a nice, it's very good for those that have, fewer transactions, and usually starting off, that's where you're going to be. Okay. So you can go from essential banking like that up to 250 transactions and so on. But we have our general checking account suite, which are those that I just described, up to the elite, which is 500 transactions and $25 a month and so on. I know the numbers don't matter. I'm just kind of giving an idea of how they're going to work. And then other areas we have special nonprofit accounts, and we have special, obviously analysis accounts, which gets a little more complicated as we do an analysis statement for you and figure out how many transactions you do. And it's as your business grows, you grow into that analysis statement. So that's something to look at. Another type of account we offer, which isn't really a bank account, but I've shared with the chamber before, is one we call solutions banking. It's something we offer to your employees. It's kind of it's a special checking account for people that work for you. All chamber members can access it. It's basically an account like an employee gets here at the bank. They do get $150 for having direct deposit. They get a bonus for that. And the key for that one, I think, is the idea that it gives them financial training and classes they can take for free online through Atlantic Union Bank. And we offer those that can help them with, some people come in and they might not know basic account information, how to save for a 401k, things along that line that are beneficial for us to offer through this account. So, that's something else we can add in that suite of business accounts. All right, Rudy, next slide, please. Okay, and now after that basic relationship, which, like I said, is the core, and that's usually where people start, then that kind of brings you to business loans. I know Rebecca had mentioned this before, obviously, talked about those and the different types we have. What I'm going to go through is what is basically needed by a bank. It's pretty general terms, is what they might need. And then Michael from SCORE will go over these probably in more detail as he explains what he does and maybe show some examples and so on. The first is the application. An application is the basic information about you, about the business. And there's not usually a lot to it, and they're pretty generic forms that you can get at most banks, usually either online or you can do a paper app if you come in and actually meet with someone. The next would be the personal financial statement. Okay, it's somewhat self-explanatory. It's going to go through and ask for your assets and your liabilities and find out where you are financially. It's a shot in time, basically, of your finances over a certain time period. Okay, and on that, the personal financial statement is going to be with you and anyone who's involved in the business. We would need that from each one of you. Now, if it's a spousal situation where you're in business with your spouse, generally it's shared finances, and in many cases, only one is needed at that point. But if there are other partners involved, each person would have to do one. Then as you go to business financials and the business, it's their business financial statement. Basically, same thing. You're just now gearing everything toward the business. Now, in some cases, maybe you've operated as a sole proprietor. You didn't keep things separate. And Ruth Ann talked a little bit earlier about sometimes keeping it a sole proprietor has eliminated the possibility of getting, financial help, grants, things along that line, because you don't have anything really stated toward the business. And so that can cause some issues with some of these funding possibilities for you. So it's very important, again, to go back to the point of keeping things very separate. The business financials are going to ask for the same thing, including then an income statement, which again is just a shot in time of what the business has done over a certain period of time. and how they've done as far as cash flow. It's going to ask for your cash flow on hand and equity statement, if applicable, if you have equipment and so on, equity in any kind of buildings you own, and things like that. And we're also going to look for a business agreement. Okay, who are the owners? What percentages do they have? How have you operated in the past, or where your sole proprietorship? But mainly, it's going to be what you are currently and who is involved in it. We now have what's called a beneficial ownership documents we have to fill out just to say who benefits from the business and what percentage are they. If they're 25% or more, we have to have all their information accurately on that form also, aside from the just ownership portion as to who's responsible for the loan. That then kind of gets us into legal structures a little bit, as far as how you're set up. If you're, and many people are very familiar with the first two I have there, the examples, sole proprietorship and LLC. A majority of people, probably at least 90%, 95% we deal with here are in those two categories. Sole proprietor, as you know, is just, and again, Rudy, if I'm saying something wrong with tax things, let me know. Generally, you're going to have a Schedule C with that and LLC. Is that correct with both of those? And sole proprietor is pretty easy. It's under your social, it's you, and you have separate business income that you're going to claim. LLC, limited liability company or corporation, is it kind of separates the two there. And again, Rudy, if I say something inappropriate, please let me know. But you're looking at taxation, of a partnership or like a sole prop, because you can do a sole member LLC or a partnership LLC, and but the corporation what the corporation does, you're limited on your exposure on that, liability wise. Is that correct, Rudy?
Yes, so a single member LLC for tax purposes looks just like you as a sole proprietor,
Right.
and a multi-member LLC looks like a partnership unless it's set up as a pass-through S corp entity.
Yeah, and then the S corps, of course, you're looking at that shares being sold and so on. So that gets a little more complicated as you grow as a company.
Yeah, Darryl, if I could just real quickly, folks, if you have any questions, please drop them in the chat box. Ruth Ann is monitoring that. We should have said that up front, and we forgot, because there's a lot of meat on the bones that Darryl's talking about, and I'm sure some of you have some questions.
Thanks, Rudy. Appreciate it. You can go to the next slide if you don't mind. Yeah, there are multiple types of business loans. These are the more basic ones that you're going to see. We discussed real estate a little bit earlier. In many cases, you might have even just an area that you keep equipment. You might have, whatever property according to what kind of business you're in. You can use that real estate to secure the loan. So it's going to work very much like a personal loan, but it's going to be under the business name and tax ID. Your non-real estate secure. This is typically what we're going to run into. And you could do that with lines of credit or whatever. But if you use business equipment, any other assets, whether it's cash, and you just want to build credit for the business, but you have the cash, but you just want to build that credit, then you can do it the same way with that. Now, business equipment, typically you're running depreciation issues and, things going, south over time. And we find a lot of farmers, landscapers, they use a lot of their equipment, whether it's tractors, you can go to lawnmowers, you can go to a number of things. And then we do have a question on there from Rudy. Just to mention unsecured. Yeah, so we do offer unsecured also. And those are going to be based on you as a guarantor, you as the individual. And if you don't have enough, typically coming in through the business, a lot of times when people start off, they're going to keep their normal job, their traditional job, and do the business on the side. We can use that income also to help with unsecured. And that's where the lines of credit come in also. A lot of times people will do unsecured lines of credit. And Rebecca spoke to this earlier, how important that is to help with, if you are in a 30, 60, 90, and God forbid it goes beyond that, as far as, you're getting payment, the lines of credit really come through for you, because you can use it at typically a lower interest rate, based on your credit and what you use to secure it. And, it gives you a little more time to be flexible. But again, I wouldn't suggest, any kind of, going 60 days out on something. But, and she had spoke to the agreements and what you should have in place earlier on that. So, and that's real. Those are kind of the generals right there. So the real estate secured, non-real estate secured, which is still secured, but not, obviously with the real estate, and then the unsecured and the lines of credit. Those are your four key ones. And, we do majority of that. We do our lines of credit unless it's for a specific project. And we might do a building, now equipment that is going to be not obsolete in a year, things on that line if it's usually not computer and technical equipment. And we'll do those sometimes individually. And we can also do secured with anything that has a VIN on it. So any of your equipment that has that VIN, we can secure, like similar to a car loan, something like that. If you buy a truck for the business, some boats, according to what you're doing, we can also track them that way. They're titled and so on. So, any questions in that area?
Darryl, I have a question that may be of interest to the group. So earlier on, you talked about all the documents and stuff that are needed, and you kept referencing financial statements for businesses. What does a business use as a financial statement for the business if they're a startup? How would they qualify for financing if they're a startup?
That gets extremely tricky there. Usually what we're going to do is we're going to try and rely on past experience. A lot of people, and you see this a lot in the restaurant business, they want to open a restaurant, but they've never owned one. They don't have an existing one. So what we try and do is look through their previous income of working in that industry and actually, trying to secure it that way. And the business financials at that point are going to be projections. So now we're looking at what, the possibility being as to where it's at. If they're buying an existing business, we're going to look at that business's financial statements that were previously there. Because we have that with, recently with another a business that, it was the same line or type of business, but they were buying a larger one. So when they moved to that new one, we just got the financials from that previous business to see where it was going to head and what that person had done at their old business to see if they had the wherewithal to continue that growth at the new one. So there are definitely ways around it. Each thing is kind of individually structured. So it does make it a tough question, but it's definitely a good one because startup is always tough. Restaurant startup is really tough unless you're buying an existing one or doing a chain or a franchise, something along that line. Just because there's not much to base it on, and they're tough to get through the first 2 years. So, yeah. As far as okay, what do you have? It's working. As far as people improving the credit of the business or credit of their own, either way, the best way to build credit for the business, probably credit cards are a good way to go. It's a good way to establish something that shows, because a lot of people, they might be playing a year or two out, get a credit card in that name and try and utilize that and buy equipment with it, pay it off, and just try and grow the business that way. Your personal, as you're going to be a guarantor for these loans, your personal credit score is definitely very important. So make sure you go into it, with a strong credit score, and also your, partners and so on. But it's startups are a little definitely catered to each person, so they're a little bit, tough to answer a blanket question on it. But there's things we can do. Anything else at this point? And, if we have to get commercial involved, um, if we get commercial involved, according to how much you're looking for, we can do all loans here at the branch for 100,000 or less. Anything over that, I tend to include my business bankers, might get more complicated, and let them handle it. And as far as a strong credit score goes, typically we look for anything over 720 would be, a very strong. 720 or above is good to very good. We can do unsecured for as low as 660 on that credit score. Um, and then a lot comes into that is also debt to income. So you could have, I've seen people with good credit scores over 700, but their debt to income doesn't line up. So they owe more than they should. And we try and keep that at about 40% of your income coming in goes toward debt. So that 40% is the key. And in many cases, there's things we have to do to pay off other debt, to put on the new one, to reduce payments, to get the debt to income in line. So, yeah, again, it's tough to have to just say what a good credit score is, because debt to income plays a big part in that.
Great. I think if nobody else has any questions,